Good deal. All right, let's turn now to some interesting investment plays to consider as the market rally potentially broadens beyond big tech into 2025. Thomas Hayes is with us. He's the chairman and managing member of Great Hill Capital. Tom, it's great to see you. So we were just talking about that broadening trend. If you had to pick now between large cap tech and everything else, what are you picking?
I think you follow the earnings, Julie, and thank you for having me on. What we've seen since the first quarter of this year is the Mag 7 earnings growth has decelerated from 50% earnings growth in the first quarter of this year to mid-teens. And what we're also seeing is the unmagnificent 493 have accelerated from negative aggregate earnings growth to positive, and by early next year, they will be low double digits to mid-teens. So you want to follow the earnings and the unmagnificent 493. I think that's where you're going to see things happen.
Tom, it's well, good to see you. It's been a little while. Look, it's a holiday shopping season. Give people some presents in terms of some stock picks. What do you like? What don't you like?
Well, I think the biggest surprise of 2025 is going to be that bonds get bid, okay? We've seen since Scott Bessent was appointed as Treasury Secretary, and he put in his 3-3-3 plan, the 3% real GDP, budget deficits below 3%, and add 3 million barrels per day. Bonds have yields have come in, so that's an opportunity to buy a little longer out on the curve. As for stocks, as for Christmas presents, I got a perfect one for you, actually maybe two if we have time. I've got Etsy. Etsy has been left for dead. Etsy was a COVID darling. The stock is down 85%. But what most people don't realize, it's the third most trafficked retail website, 92 million users. And what's really interesting about that, Brian, is that they don't compete. It's not a race to the bottom on prices, because the things you can get on Etsy, you can get nowhere else. And this is a company that, while the stock is down 85%, they've been able to maintain all the users they picked up during COVID and maintain the free cash flow generation is re-accelerating. 600 million plus trailing 12 months, $1 billion buyback authorization, growth in international, growth in men's, growth in gifting, growth in loyalty programs. We like this one.
And of course, now I'm seeing Brian Sozzi next to me,
I
commencing his holiday shopping by going on Etsy.
I'm looking at digital prints. I mean, maybe you're right here, Tom. I can get a digital print of my non-existent puppy and put it right there on my desk.
You go.
I mean, this, what Etsy's showing here is Bailey the puppy. I mean, it's great.
So, Tom, let me ask you, though, because one of the reasons that the stock has taken such a hit has been sort of concerns about that it hasn't maintained that level of specialness, right? That there are counterfeit goods on there, that it's not as curated, et cetera. What do you think about that? Do you think Etsy's been doing a good job of sort of addressing some of those concerns?
No and yes. No, they haven't been doing a good job. That's why the stock's down 85%. Yes, they recognize the mistakes they made and they're fixing it. And that's why we're seeing a re-acceleration of growth, revenues, proper initiatives, curation, and an abandonment of what they were doing, which was trying to compete with people that they don't compete with. You know, Brian, when you go out to get that picture of your puppy, you want to engrave the recipient's name on that picture, and it will make them feel special. I mean, when you receive a customized gift from a friend or family member, it's special because they took extra time, they were thoughtful about you, versus just scattershotting 20 chocolate baskets from Amazon is not the most ideal situation anymore.
And now I'm going to have to get a puppy. I don't have one, but I just want a puppy. I want to take a photo of it, and I want to share it with all of you. Tom, before you came in here, Julie and I were having a chat on tech stocks and seeing some weakness in the semiconductor names. Is there any read-through, any cautionary signs from some of these stocks that were some of the favorites amongst investors now getting tossed in the trash?
Well, as it relates to NVIDIA, we saw a lot of retail investors chase into that after the split. They got some benefits. But, you know, at the end of the day, you have a stock that's priced for perfection, trading at some 40 times sales, 40 times forward earnings. A lot has to go right. And the problem is there was a period in time when NVIDIA, the stock price went up and it actually got cheaper because the multiple went down. That is no longer the case because profit margins have capped out. Revenue growth has capped out at a measly $4 billion a quarter, which is still absolutely incredible. But the key is price is what you pay, value is what you get. And at 40 times sales, as we move from training the models, which is where GPUs are the most critical and the spend for GPUs is the most important thing, to the more efficient part of the AI process, which we're slowly shifting into, which is inference. Inference can be done on more basic chips with lower energy use, lower demand, more chips, but lower quality chips. That's where the AMDs of the world and the Intels of the world are going to start to arise from the dead, and the pie is going to be split up a little bit better. So on that basis, maybe they can eke out a couple more quarters of stock growth, but where it's priced, I think it's certainly makes sense that it's consolidating and stalling a little bit and maybe even pulling back.
I want to come back to your bond call, because I find that kind of interesting, Tom, because there are, of course, all this talk about tariffs maybe keeping rates, meaning that inflation is going to stay higher, meaning that rates are going to stay higher for longer. We're not going to see as many cuts. How does that factor into what you're expecting?
Well, this was the exact same thing that happened in Trump 1.0. He was elected in November of 2016. The first thing you saw was, oh, it's going to be inflationary. He's going to spend. He's the debt king, or the bond king. And immediately, long end of the curve, sold off aggressively after the election and into his inauguration. And it was kind of sell the rumor, buy the news. When he actually got in, bonds had a meaningful rally in 2017. Same thing with the dollar. As soon as he was elected, it had this knee-jerk strength all the way into January, into the inauguration, and then weakness. And I think those are going to be two big surprises in 2025. Bonds get bid, yields compressed, dollar actually weakens. Maybe not the next few weeks, but as you look out 6 to 9 months, that will be the case. And if you look at the inflation during the Trump 1.0 administration, it was subdued. There were a lot of different conditions. I'll give you that. History does not repeat. It does rhyme. But the other thing that was odd about 2017 to 2020 is emerging markets did exceptionally well. When he was a pro-tariff, the tariff king, he ran on the tariff king, and emerging markets had really tremendous rallies as the dollar weakened. So I would be open-minded. And the other thing that people think, energy is going to do great. Energy did very poorly under the Trump administration, and so did retail stocks. After initial rally into the inauguration, retail stocks were very weak in that first year, probably on the fear of tariffs as well. So I would just be burdened by the facts and the data versus the hearsay of what might happen or perceptions about what would happen. Look at what actually happened and see where the conditions are similar and where they might be different. And I think there's tremendous opportunities in the next 12 months in doing that.
Thomas Hayes, Great Hill Capital Chairman and Managing Member. Always good to see you. Appreciate the picks. Appreciate the puppy suggestion. We'll talk to you soon.
Thanks so much, Brian. Thanks, Julie.
All right, now time for some